The world's most powerful chips just hit a wall. Overnight, China didn't negotiate, didn't threaten. It banned every U.S. semiconductor from its state projects. Billions in orders vanished like they never existed. And while Washington was still drafting its response, Moscow and Beijing made their own announcement. From this moment, every deal between them, oil, gas, weapons, AI, would bypass the US dollar entirely. One decision cuts America's tech lifeline. The other strikes its currency. Together, they might just rewrite global power itself. For the first time, government funding in China's data infrastructure program now came with what Bloomberg described as a technological passport. Officials tied the release of credit and subsidies to proof of domestic hardware. What seemed at first like a procurement rule began to look like an industrial firewall, one that would keep the world's largest digital infrastructure market sealed from U.S. semiconductors. The Financial Times noted that public sector data centers account for the majority of large-scale AI compute in China, meaning the order could shift tens of billions in hardware spending. Nvidia's chief executive admitted that his company's share of China's data center accelerator market had fallen from roughly 95% to zero. He told reporters that shipments of advanced models were not occurring, acknowledging that export control restrictions and Chinese procurement rules had closed the corridor entirely. For Wall Street, that statement confirmed what price screens had already implied. The corridor that once delivered a quarter of Nvidia's revenue had collapsed. Intel and AMD still sold general-purpose processors, but Beijing's rule left little ambiguity. Bloomberg's industry analysis suggested that public sector preference tends to cascade. Once state money moves in a direction, private buyers follow to avoid regulatory friction. That is why traders treated the directive as more than symbolism. It marked the institutionalization of self-reliance. The world's largest economy by output had drawn a permanent line around its AI core. Behind this drama lies a deeper test of balance sheets. Data centers have become an asset class. Bloomberg estimated that about $49 billion of data center mortgage-backed and asset-backed securities are outstanding, tied to buildings whose value depends on servers and rent from AI tenants. Another $60 billion in pipeline deals sit waiting for buyers. If chip deliveries stall or power prices rise, the cash flow math behind those bonds changes, and with it the stability of a new corner of the credit market. The corridor lights dimmed. Wall Street calls this structure digital infrastructure, but in essence, it is leverage stacked on silicon. Every node in that chain, servers, tenants, bondholders, depends on confidence that the chips will keep coming, and the leases will keep paying. China's ban introduces a variable that credit models cannot price: geopolitics. A single export restriction can now ripple through tranches in New York or Singapore. If refinancing freezes, the contagion would echo the dynamics of 2008, though on a smaller scale and inside the architecture of AI. Two hypotheses define this moment. First, that China can substitute domestic chips quickly enough to sustain its AI expansion. Second, that United States capital markets leveraged into this boom have underestimated how political risk distorts cash flow. On the first, Huawei's manufacturing unit has announced plans, Bloomberg confirmed, to double output of its Ascend 910B accelerators next year, signaling confidence in local demand. On the second, debt investors now face the realization that every AI-related security is partly a policy instrument. Somewhere in Hangzhou, rows of chips clicked beneath green indicator lights. Chinese engineers argue that even if domestic silicon trails Nvidia's latest Blackwell generation, system-level clustering can compensate. They can string together dozens of cheaper cards, linking them with proprietary software to approximate the same performance. The solution is inelegant but cost-effective. As one industry analyst in Beijing told the Financial Times, "You lose efficiency, but you gain control. Efficiency can be improved later. Control cannot. Each dollar denied to U.S. suppliers now flows into Chinese R&D budgets. That diversion matters. The more procurement shifts to Huawei, Cambricon, and Biren, the more revenue stays home to finance design iterations. Domestic engineers call it a virtuous constraint. By necessity, they are building without U.S. hardware. By design, they are building an ecosystem independent of U.S. export policy. It is a slow decoupling, but a deliberate one. China's strategy extends beyond chips. The International Energy Agency's latest renewable capacity report shows China holding roughly 2/3 of global new solar and wind installations. Reuters calculated total installed renewable capacity at more than 340 gigawatts by mid-year, already outpacing most forecasts. That scale matters because AI computing devours electricity. Lower energy costs grant China a structural advantage in training and data processing capacity, even when chip efficiency lags. Energy has become the second front of the chip war. Power prices for industrial users in China are roughly 30 to 40% lower than U.S. averages, aided by state subsidies and new grid investments. The IEA projected that by the early 2030s, China's solar generation alone could exceed the total electricity consumption of the United States. Whether or not that forecast proves exact, it illustrates an asymmetry in resource planning. Technology races may now hinge on kilowatt hours as much as on algorithms. Yet abundant power brings its own constraints. Reuters has documented high curtailment rates in several northern provinces, meaning excess renewable energy often cannot reach demand centers because of transmission bottlenecks. That limitation complicates claims of an unassailable Chinese advantage. If storage and grid flexibility do not catch up, local shortages can offset headline capacity. The reality lies between triumph and limitation, massive generation potential bounded by physics and infrastructure. The United States, for its part, has anchored its AI expansion in debt. More than $25 billion in new borrowing this year is tied directly to data center development, and nearly $50 billion more sits in securities held by institutional investors. Those numbers, reported by Bloomberg and S&P Global in October, reflect a faith that rising demand for compute will absorb rising interest costs. If that faith weakens, liquidity dries up fast. China understands that vulnerability because it has seen the pattern before. Asset inflation, leverage, and sudden stops. That awareness gives Beijing leverage without firing a shot. By tightening technology access while maintaining its own build-out, it can slow American firms' revenue and potentially strain the financing chains behind them. None of this requires overt confrontation. It only requires persistence. The hypothesis worth testing is whether the U.S. system can out-innovate faster than its balance sheet tightens. If not, the AI boom could transform into another credit bubble. Meanwhile, the financial architecture of global trade is shifting elsewhere. Reuters reported in late October 2025 that Russia and China have completed nearly all bilateral trade settlements in their own currencies, ruble and yuan, bypassing the dollar almost entirely. Officials in both countries say more than 90% of transactions now avoid Western clearing systems, though exact percentages above that remain unverified. The transition has accelerated as sanctions made dollar transactions cumbersome and politically risky. Trade between Russia and China reached roughly $245 billion in 2024, up from less than half that 5 years earlier, according to Chinese customs data cited by Reuters. The expansion coincides with a surge in yuan-denominated debt issuance in Moscow, including plans for a sovereign yuan bond. Bloomberg wrote that Russian institutions now hold enough yuan deposits to finance local borrowing directly. That liquidity pool has become a quiet alternative to dollar funding in the region. The implications for the dollar system are measurable. Every transaction settled outside Western banking networks erodes demand for dollar liquidity, even if incrementally. The IMF's recent update still lists the dollar at about 58% of global reserves, but the trajectory points lower. Central banks in emerging markets have increased gold holdings by nearly 800 tons over the past year, with total reserves in bullion now surpassing $4.7 trillion in value, above the $3.9 trillion held in U.S. treasuries. Those figures, drawn from World Gold Council data summarized by Bloomberg, hint at a structural rotation. It would be simplistic to declare the end of dollar dominance. Liquidity depth and legal predictability remain unmatched. Yet the shift in marginal transactions, where new trade occurs, signals diversification. Economists quoted by the Financial Times caution that de-dollarization is less an ideological campaign than a risk management exercise. The more Washington uses financial sanctions, the more counterparties design around them. Logical self-interest replaces loyalty. U.S. policy responses have mixed effects. President Trump's tariff program, reinstated and expanded through emergency powers, has prompted retaliatory diversification rather than compliance. Reuters reported in mid-October that Chinese exports to the United States fell 25% year-on-year, while total exports dipped only 1%, suggesting that lost American demand is being replaced elsewhere. For every sanction or tariff, a workaround emerges. For every wall, a new corridor forms. Inside Washington, the Treasury under Secretary Scott Bessent faces a complex trade-off. Higher tariffs generate short-term revenue but raise inflation risks, forcing greater bond issuance to fund interest costs. Treasury's own projections show a fourth-quarter borrowing need of roughly $569 billion. Bloomberg's coverage notes that this estimate already excludes potential tariff refund liabilities under Supreme Court review. The fiscal room for maneuver is shrinking just as geopolitical exposure grows. The early phase of confrontation has given way to normalization. What once looked like escalation now reads as system design. China is institutionalizing self-reliance. The United States is securitizing ambition. Russia is monetizing alternatives. None of it feels reversible. The emotional undercurrent in markets has cooled from alarm to resignation. Traders no longer ask if decoupling can be stopped, they ask how to price it. Can China's domestic chip makers scale without foreign lithography equipment? Can the United States financial system absorb another debt-driven technology wave without breaking? Can global trade settle efficiently across multiple payment rails? None of these have definitive answers yet, but all three questions now anchor investment models. The world is no longer adjusting to shocks, it is adjusting to parallel systems. Even in the uncertainty, some constants remain. Innovation continues on both sides. So does mistrust. Huawei's claim that it can meet demand with local chips is plausible but not proven. Nvidia's pivot toward other markets can offset losses but not replace them. The AI economy will not stop because of politics, but politics now sets its speed limits. Every watt of power, every bond issue, every customs invoice reflects the friction of a divided system. In Moscow, the experiment with yuan finance continues. In Beijing, officials review each procurement plan for compliance. In Washington, debt managers calculate the yield premium required to keep investors interested. Each decision seems small until it interacts with the others. The Semiconductor directive may appear technical, yet it touches debt, energy, and currency in one motion, a reminder that economic systems fail or endure not through ideology, but through interconnection. Whether China's latest rule marks the definitive break or just another milestone in a long decoupling, its immediate effect is measurable: less U.S. hardware in Chinese racks, more domestic experimentation, and greater uncertainty in global financing. Investors respond not to ideology, but to cash flow. As cash flow diverges by geography, so does the architecture of globalization itself. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.